We've rallied back pretty nicely. Santa Claus rallies typically happen 2 days after the new year as well to find out if there's some conviction to this rally. So the buy the dippers have been in this market over the last few days, and we saw that start last week, and it's continued today. So expect volatility. I mean, certainly we've talked about that all day, I'm sure, but you know, that's not going to go away with any kind of tweets or any kind of inflammatory remarks we get out of the White House.
Paul, you guys have done so much work on seasonal impacts and factors. How important is today and the month of January, and how reliable of an indicator is all that anyway?
You know, I think it's, it works sometimes and it doesn't work other times. So I wouldn't put too much weight into it. I think it's, it's encouraging that we opened up weak and rallied throughout the day. But keep in mind that, as Mike was just saying earlier, this is the third straight month now where we saw a 5% rally in the S&P 500 to close out the month. And all three of those months weren't the greatest months. It's an opposite of the trend we saw earlier in 2018, where the market would fall towards the end of the month after strong gains. So it's just a matter, I think, of rebalancing towards month end. And there's still a lot of unknowns in the market that DC dysfunction hasn't been settled. The Fed's still an issue. Trade's still an issue. So I think we could. Wouldn't surprise me to see short-term lower gains here, but when you look back at these prior periods, which you guys have been covering a lot over the last several weeks, we've seen very extreme readings in a number of internal indicators. And the key is that while a year later you tended to see strong market returns, in the short run you tended to see a lot of volatility, and most of the time you saw lower lows. So I think if an investor could, you could start putting a little bit of money to work here. There's some names we've been attracted to, but be prepared for more weakness in the 1 to 3 month time frame.
And Rick, I recall from last week you were talking about how the bond market has a way sometimes at the start of a year of making a bit of a splash, of making some kind of a decisive move in the way of yields. What's your read on today's action, as we do have yields mostly lower, I would say?
The beginning of last year, the end of the previous year, we established, as you just pointed out, the low yield on the first trading day, virtually in the low 240s. I don't know that we could make that same comment now. I doubt if 266 is going to be the low yield, or 265 now, for the 10-year notes. However, I will say that the level that we referenced, that 240 level, we started out at 218, will be huge support. But I do think there's a very good chance to test it for two very big reasons. One is collateral, margin, capital charge. There's a lot of institutions out there during periods of volatility that are going to seek to put a lot of treasuries on their balance sheet because they get the smallest haircuts. Add into that what we call the no money down players in the equity markets. I really think that's much of what's going on the last couple months.